It's wonderful to have all of you here for the first edition of Cafe Mutual Conference, Wealth Management. This is the first time that we are doing an event which is targeted exclusively at banks and national distributors. We do two other events which have become very popular. We do something called Cafe Mutual Confluence, which I think is today established as the thought leadership event of the entire mutual fund business. We have another event which has found a lot of support in the IFA community, which is called CIFA, Cafe Mutual IFA event. What makes this event different is I believe that the needs of banks and national distributors quite different from any other set of distributors. There are a couple of events in this space which target banks and national distributors, but I consider them to be purely marketing events, where they create a platform for fund managers to come and talk about their products. We thought we'd do it a little differently. We thought we'd keep that part of product out of this and focus more on coming out with ideas which support your business. So, very happy to have all of you here. And we have, through the day, we'll have 28 speakers. We have 9 sessions. I urge you to make the most of it. I have 2 suggestions. One, we've kept ample time for audience questions at the end of each session. So there will be people going around with mics to make the most of it. Shoot whatever questions you have, but keep the urge to ask questions till the end of the session. The second request is, I know all of you are busy folks. I know your clients are wanting to be in touch with you. Keep your cell phones on silent. That would be really appreciated by the entire audience and all the speakers here. So welcome once again. Without much ado, let me start with the first session. The first session, we have an august panel of people. We've tried to put together a panel which cuts across the diverse segments which make up this entire business of wealth management. So I will call out each of the speakers one by one and invite them to come here. So let me invite by asking Rishikesh to join me on the podium here. Rishikesh, please. Rishikesh today heads Ambit Private Bank and Ambit Fininvest, which is the NBFC. Rishikesh has been with Carvey earlier, with Morgan Stanley, and with McKinsey. Really a very illustrious career. And I think it all started when he got the President's Gold Medal at Ahmedabad. So big hand for Rishikesh here. So let me move from one gold medalist to the other. I'm happy to invite Nilesh Shah, who is the CEO of Kotak AMC and one of the best regarded investment experts in the country. So Nilesh is a chartered accountant and a rank-holding cost accountant. Nilesh has been with Access, Prudential ICICI, Franklin Templeton, and ICICI Securities. During his tenure as a CIO and fund manager, his team and him have won a lot of awards, including, I think he's got Business Standard Best Debt Fund Manager of the Year, and he and his team have been given the award twice for being the best investment team in the country. So big hand for Nilesh. Thanks. I can now invite Soumya Rajan to come on the stage. Soumya runs Waterfield Advisors. She is at the most exclusive end of the business. She runs what is called a multi-family office business. She was the head of the private bank at Standard Chartered till 2000 year, and since then she's moved on to set up Waterfield Advisors. She's worked, her career has been largely with Grindlays, which was later acquired by Standard Chartered, and she continued. She's been with them for about 17 years. So welcome, Soumya. And I now invite Prateet. Prateet Bope runs the wealth management business at ICICI Bank. Prateek has worked with ICICI Bank, and this is his second job. So welcome. Thank you. Okay. One gentleman who could not join us today is Mr. C. Jayaraman. He's taken ill, so he's not been able to come with us. So anyway, so let's get started. So what we will do is, since these people represent different businesses, I'll start by requesting all of them to spend about 2 minutes talking about the essentials of their business. What business do they chase? What kind of clientele do they have? What kind of products, and what's their revenue model? So if I can start with you, Prateek, you're the...
Sure. So I think this panel, obviously, by the very nature of businesses that each of us manage, I think my business or my institution probably is the most well understood. So to that extent, I think we run a wealth management business within ICICI. We've sort of run this business for a long time, but I think over the last 5 years, we really changed the way we approached this business within the bank. The differentiation that we made was that earlier we used to pretty much look at all the customers through the same lens. And I think over the last few years, we've, basis the segmentation that we did within the bank, we created a top end of customers within the bank, which we then categorized under wealth management. So the segment of customers we deal with are what all of us would know as HNIs in the wealth management business. There are other customers which are below the wealth management base, which are managed differently by branches, and then there is this ultra HNI space, which is what is called as private banking, as all of you are aware of, which is dealt with differently. So the wealth management base within the bank is a fairly large base. It is quite different from, I guess, some of the challenges which my colleagues would face in their businesses, where they need to go out and acquire customers, and that I know is a large challenge for most of the people in this business. I think we, by the virtue of being a bank, have the good fortune of having a large base of customers that we sort of have and need to focus on in terms of penetrating in order to sort of manage them well. So the focus clearly in the business is to try and do more. The challenges for us remain similar to what probably are there within the other institutions. It's really to try and deepen the relationship that we have with the customers that we manage. But I think the bigger challenge really is to try and do more with the customer across products. So it is not necessarily restricted to only investment products, but by the virtue of being a bank, we obviously try to ensure that we extend the product suite to business banking and the normal banking products like cards, mortgages, and so on. And I think that's really held us in good stead, because when this business goes through the ups and downs, and when a lot of things which come into question are the cost or sustainability of this model, like it came into light in the recent changes on the mutual fund commission side. What really helps us is that we have multiple products, and hence the ability to withstand these ups and downs in this business. So that's what really differentiates us.
So, but what part of your revenues comes from non-banking products?
So that's grown year on year. It's not as large as what we do on the investments side, but I think the good part is from not having anything happening on that side, it's now in the early teens, so it's fairly substantial now.
Yeah, Rishi.
Sure. Good morning, folks. My name is Rishikesh Parandikar. I have joined Ambit fairly recently, so it's been about 3 months, and I run both the NBFC lending business as well as the wealth management business. So I jokingly say, ek haath se leta hoon, ek haath se deta hoon sort of thing, right? And so I end up straddling both sides of that spectrum. Before that, for many years, I ran Carvi. I set up the wealth management business, including some proprietary asset management products as well as the broking businesses. And that was when I came back from the US. And so for the last 5-6 years, my journey has been to discover what this wealth management industry is about and how to go about creating a positioning in that industry which makes sense and which makes money. And so that's been the continued journey. So what I will say in terms of Ambit is more about what I would want to do as opposed to what we are already doing. Ambit is currently a fairly boutique financial services organization, started out by Ashok Wadhwa as an investment bank, and then has kind of gone into other segments. And so we now are one of the more prominent players in institutional equities, being among the top ranked sort of institutional brokers. We have an interesting set of proprietary products in terms of alternate asset management. We also do a lot of investing on our own account from a private equity standpoint as well as a principal standpoint. And then as I said, we do the private wealth and NBFC activities. So the focus from a private wealth standpoint is to be more than anything else, a private investment bank. And so I don't want to just be somebody who is out there recommending investments. Our focus clearly is on the HNI and family office segments. But the idea is to not just limit oneself to a few asset classes, but straddle across equity, fixed income, real estate, commodities, as the case may be, as well as help clients with their needs on the borrowing side, right? Not just from an NBFC standpoint, but more broadly help them with business loans, as the case may be, for business owners. And so it's trying to be on both sides. One of the core focus of how we want to do business is to be differentiating ourselves in terms of the quality of product we bring to the table, which is where I have concluded the model that I want to be able to run is around largely predicated on bringing stuff which is relatively proprietary and relatively focused on only or largely available through me, right? And so you'll give during the course of the discussion, I'll talk to some other examples on that. But that's basically the premise on what we will build the business on. And so while we try to build an advisory practice in terms of getting paid as an advisor, most of the money really will get made from both distribution of our own proprietary product as well as distribution of third-party product. That's kind of how we make it.
But what kind of clients do you target in your private? So what is the size of relationship, or what is their net worth? How do you decide which clients to go after and which?
So it's actually quite simple. We'll basically say we will start a relationship at least a 1 crore number with us, right? And rather than talk about what the client has, it's a 1 crore with us. And we end up sort of focusing on largely business owners in some fashion, partly because of the pedigree and the name that Ambit has. We are trying hard to make sure the investment bank is a seamless flow of relationships to us, and that's something which is work in progress.
Okay. Soumya, you have an interesting model. Tell us about it.
Yes. Just to share with you a little bit about what Waterfield Advisors does. We are a pure play advisory company that works specifically with family-owned businesses. We run two verticals in the company. One is a multifamily office, and the other is a corporate advisory desk. And that's essentially because the client segment that we're catering to is really the business owner or the entrepreneur. Just for the sake of providing a little bit of clarity on what is a family office, unlike a private bank, a family office actually is a dedicated platform and a dedicated team that actually works with different families in order to look after both their lifestyle as well as their financial needs across multiple generations. So what that really boils down to is that how do we work with families in helping them in financial planning, in investment management, in risk management, in charity and philanthropic activities, as also how do we help them in business advisory, and in terms of management of closely held companies. So this essentially is a platform where you can get holistic end-to-end services for a family, which is not specifically in one area. So unlike where a family may have a separate lawyer, a separate chartered accountant, may have someone separate for their investments, the family office platform looks to integrate this all under one roof. Globally, there are close to about 5,000 family offices across the world, Essentially, they all started as single-family offices where families that came into substantial wealth because of a complexity in their financial situation, they set up what is known as a single-family office. But over a period of time from the 1980s or so in the US and more developed markets, the single-family office has morphed into what we call a multi-family office. So where different families use the same services that are provided by this platform. Interestingly, family offices globally manage close to about $2.5 trillion in assets, which is actually more than hedge funds today. So it is one of those somewhat unknown class of investors, what one could typically call semi-institutional, but is a growing phenomena in India.
So, but what kind of clients?
Our
So
client segment.
How much did the client? What did the client's net worth have to be for him to qualify to be a client?
Minimally in the US, typically family offices will start where you're managing more than about $100 million. In India, I would say that family offices get set up typically where there is more than 75 to 100 crores of investable assets, financial investable assets. So take out real estate, take out the net worth issues that come about from the corporations or corporates, but essentially 75 crores to 100 crores of minimum financial investable assets.
So how many such clients do you have?
We work with about 30 different families right now across India of varying sizes, which have different requirements because you're looking at investments, you're looking at legacy, you're looking at trust and estate planning, you're looking at philanthropy, you're looking at merger and acquisition opportunities in the very early stages as a sounding board for that family. So in some ways straddles what a business does, banks do in terms of both the investment banking as well as the investment management piece for different institutions.
Okay. Prateek, India, the number of wealthy growing in this country, the wealth which is being created in this country is phenomenal. Any report, world report says India has contributed the maximum number to the growth and things like that. But doesn't seem to be getting captured in the assets under advisory of wealth managers in the country. Why is that?
So I think I think the way to answer that is we've obviously had what I call as traditional wealth or old wealth, right? And I think if you look at what's happened to the country over the last decade, I would say from 2000 to 2003, you've seen a growing number of new wealthy which has happened over the last say 10, 12 years. I think if you look at what is happening with the new wealthy, to my understanding, most of that wealth would get managed by your banks and institutions such as what Rishi deals with or Soumya would manage and so on. But I think it's really the legacy wealth or the old wealth or the traditional wealth which would be your second generation, third generation and so on. I think that has started getting exposed to the wealth managers over the last few years, right? I think that piece of money still continues being managed by the CAs or the old trusted advisors and so on. So to that extent, I think we are definitely seeing a transition. You will definitely see far and far sort of convergence between the numbers that institutions manage and the wealth which exists. But that's a slow transition, and that's what is underway. The other reason is, I think, the old wealth, as I call it again, the fascination of that fraternity with hard assets like real estate and gold. That's again something which institutions such as ourselves will not necessarily deal with because these are not liquid, and Nilesh, I know, talks about it a lot. But that's the part of wealth which we will not deal with, and that's a fairly substantial number. That's the other reason why you will typically see a divergence between the wealth numbers as what get reported and the wealth numbers that get managed by institutions such as ourselves.
But Nilesh, you've been on both sides. Why is it that a lot of wealth doesn't seem to be coming on to the financial services sector? Where is it going? And what needs to be done to bring it? And what can wealth managers like them do to get this money here?
So one, there is a parallel economy, and that wealth will never come into the official accounts. The second is the sheer length and breadth of the distribution community. I mean, today there are 500 agents who get more than 5 lakh rupees for selling mutual funds in a year. So unless until you create a pull, how will the push come? Third, in many institutions, wealth management has become transactional rather than relationship oriented. Most of the clients whom I have met, they have complained that I don't know whether the RM will be there after 6 months or not. And he's giving me advice for 5 years. So again, the model which banks will have to, create is where RMs probably stay in the system for a longer period of time, or the processes takes over so that RM doesn't really matter. The other thing is that, today the wealth is actually situated in the hands of people who are, let's say, 45 plus, and they are more accustomed to physical touch rather than process or system touch. And there are a host of CFOs, chartered accountants, who are able to do the job of wealth manager without being recognized as a wealth manager. And they don't have to take ARN, they don't have to go through SEBI regulations, they don't have to go through NSE certification, and they're still doing a far better job. So in some sense, we require a transition where professionals starts taking over from the amateurs, stability of professionals in organization, processes taking over people, and the parallel economy getting integrated into the official economy, and boom, the whole wealth management industry will just take off.
Prem,
Yeah, sure.
I just had a comment on, why is it that we're seeing much more money sitting, obviously, in real estate or some of the hard assets. And we actually did a study recently on asset allocation and saw returns over 5-year rolling periods, and we actually found that since 2007-8 till in that 5-year period, real estate did give the highest and maximum did give the maximum returns. So you're also going to find that investors are going to chase after those asset classes that are giving you the kind of return which is exponential as compared to, let's say, financial instruments in that same period. But also, I think, keeping in the context of India was a high inflation economy, and at the end of the day, when you have high inflation, you are going to see a predominance toward hard assets in terms of the preference of an investor as compared to financial assets in that scenario.
Sorry, one other comment. So hard assets apart, right? In Karvi, we had this thing which we created, Karvi Wealth Report, and there's 4 editions which we've done over the last. And so even excluding the hard assets, you think about the financial assets, there's about 1 lakh crores, give or take, of financial assets. But a big chunk of that is in 2 big categories, which is in bank deposits, and it is in sort of illiquid promoter equity holdings, right? And that will account for 2/3, if not more, of sort of the monies there. And so it depends on how you define wealth management, right? So if you think about wealth management as a multi-office, small boutique, if you like, which is dealing largely with mutual funds and investment products, then it's very different. If you think about it more broadly, because eventually there is a huge tail of independent financial advisors and advisors who are wealth management, just seemingly less organized. And so I think that the bigger, I guess, in a way, I look at my challenge as saying, how do I get people out of bank deposits into things which are hopefully relatively similar in risk characteristics, but are providing better returns? Right? That to me is the number one sort of enemy, if you will, in terms of what I look at from my standpoint. But that's just my definition of what I think of wealth management. If you think about it more broadly, it is being served in some fashion or the other.
Okay, Rishi, I'll stick to you. Want to know, how do you go about acquiring clients at Ambit, Prateek has a bank and he can, I mean, he has banking customers. He has branches all over the country. He has 40,000 people. How do you go about acquiring clients at Ambit? Ambit is not even an institution with any history.
So you're making me feel really good.
Yeah.
But the thing is, I mean, I guess there is the obvious sort of connects in terms of saying Ambit.
No, because a lot of people here are individuals who are looking to get into wealth management.
Sure.
And they're working for organizations where their key task is they do not, many of them are not working for the likes of Citibank and, ICICIs. They're working for smaller companies. How do they go about acquiring clients?
So that, of course, is the biggest challenge, right? So the one obvious set of things we do is to be able to leverage connectivity across our multiple businesses to be able to refer clients. So be that investment banking, be that clients we deal with in the institutional equity sides or so on and so forth. But like I said, what I'm trying to do is basically build this notion of saying stuff only available here, right? And so show something interesting different. So for example, in the last 2 weeks, we were the only ones in the country who had the opportunity to show investors to be able to invest directly into Uber in San Fran. Right? And so, and so it was a big ticket sort of thing, but we were the only ones who were able to show that. Now, whether that's distribution, whether it's advice, it's an interesting investment opportunity. Right? And so, things like that, we will continue to do. It has a high premium in terms of sort of thought and time, but stuff like that is something which we will do. So, I'm saying references through businesses, but as well as then building a platform which gives interesting, unique opportunities is what we are trying to position ourselves in, and that's how we will go get clients. So we have got a lot of sort of mileage from saying, ye dikhaya. Now, how many people do or not do is actually secondary, but that kind of builds a cachet in terms of saying these guys will talk about something different.
Prateek, the largest bank in the country. Now, clearly, there are many wealthy people in this country straddling different segments. So, how do you segment your market? Because contrary to normal perception, I think the wealthy are not some homogeneous set of people. There would be different profiles, and wealth reports keep talking about it. So how do you profile, how do you segment your clients, and do you have a separate approach, do you have a separate message for each one of them?
So I think given the virtue of being a bank, I think in terms of data, there is just so much data that we have. The ability to segment and do cuts and deal with those differently, the desire is very, very high. So I think the challenge is, while we can do a lot in terms of sitting at a corporate office and saying how different cuts can be made and different profiles can be created and how we could have different opportunities that could be identified for different profiles, I think where the rubber hits the road, it all fails, right? So when you go down to execution and you expect that the RM who's got, let's say, 150 customers, who potentially in our mind sitting in a corporate office may have 15 different profiles of customers. You may think that he should deal with them in 15 different ways because these are 15 different profiles of customers, right? But like I said, when it goes down to execution, it doesn't work. So very honestly, do we do a lot of profiling? Do we have the ability to do a lot of profiling and create different sort of or identify different behavior sets and need sets of customers? We do. Do we really see that sort of fructifying into results? We don't. So what we've done, very honestly, is while there are various attempts that we make at different points of time, and like I said, it's a very strong desire, but in order to ensure there's a fine balance between what we think we should do and what really happens, we follow a traditional path. So we've segmented the base on your salaried, self-employed. Within self-employed, we've got non-professionals, professionals, and then we've sort of ensured that there is a good mix which is given to each RM. However, what we do probably a little differently, that the RM then is supported by an investment advisor, a business banking advisor, an asset advisor, and so on. The idea being that you don't really expect the RM to be a master of all, right? He should be competent enough to deal with all products, but where there is expertise needed, he can just go and pick in the expertise that is required for the respective client engagement. So the base, like I said, we've got salaried customers, self-employed, professional and non-professional customers, and then basis the need that the customer has, he sort of brings in the expertise as is required. Like I said, the base, the desire can be manifold, but I think we're still some distance away from really seeing execution of that.
Talking about expertise, I wanted to ask you something. You say that you seek to replace the advisors that some of these families have. So you seek to replace their lawyer, their chartered accountant, their investment advisor, your banker. Now, and you are targeting people who have a minimum net worth of say 100 crores, or you said investable this asset. Now that's a huge task. Where do you get people to do it? I mean, where would you hire such people who have the confidence to go and talk to such clients and talk with a certain degree of authority and competence?
Prem, I think I'll just make a clarification here. It's not about our replacing in terms of the accountant or the a lawyer or the banker. What we are actually trying to do is the way the multifamily office actually functions is that you're a free radical in the system.
Okay.
What you're looking to do is find the best solution for the family from wherever it sits.
Okay.
So there are services in a multifamily office that are outsourced.
Okay.
There are services that are actually you provide in-house and you build capability in-house. The intent ultimately being that even within, let's say, law firms, there could be multiple law firms that have a specialization in different areas. So what you're trying to do for the family is that if the requirement is in, let's say, an M&A deal, or if the requirement is on how do I structure an offshore company because my business is growing, then you will actually go to that law firm that actually has the best expertise in that area. So ultimately, I think one of the reasons why multifamily offices can be extremely successful is because you're not dependent on an in-house solution always, because you're actually trying to find the best solution for the client in wherever it actually sits. That makes a huge difference in terms of the ability to provide great service to the client. The other is that because you are having these networks with these various institutions, you are actually lowering the cost if the client does that transaction, let's say through you, because you're saying that I'm servicing 30 different families and I, let's say, have a very good relationship, let's say, with Nishit Desai or Khaitan and Company or AZB, then we actually help them get it at a lower cost because we know these particular providers extremely well. So the whole concept of the multifamily office is bring down the cost but create the real value add in terms of where do I get the best solution for the particular family.
Okay. And now, Nilesh, you've seen both sides. There's this huge issue of talent. I'm finally told that if you were to go around looking for private bankers, you have a pool of 500. And if you stretch your definition of wealth managers, then at the most, all locations in the country, you have 5,000 people. So where do you get 5,000 people servicing so many wealthy people in the country, managing so much of wealth? Is it possible?
So again, in a country like India, if people say that we have limited talent, the problem lies with the manufacturers rather than with the people. Can you not train people? It's pretty sad to say that how many people are investing into their businesses. If I look at asset management companies, probably most of the asset management companies have taken away their capital and multiple times that return over last many years. But there is no institute where you are training distributors. There is no industry forum where you are, teaching how to be a good distributor. So clearly, without making investment, if people keep on complaining that there is a lack of talent, the blame lies on ourselves rather than on the talent. There is enough talent available, one just has to make investments in training them, in educating them. The limited fault also lies at the distributor level. Today there is enough, literature available at the websites of most of the mutual fund insurance companies, even within the bank, the training, there is enough trainer recruited by various institutions. But many a time, the knowledge which they get, they are thinking that as a, long-term and boring, and they want to go to the shortcuts which can give instant return for the customers. In 2008, when the crisis had hit, I've seen so many customers complaining that, look, we are not able to reach out to our managers, our PRMs. Now, in the crisis time, you have to hold hands of your customer. There is no choice. You can't be running away. So, it's a complex problem which requires solutions in the form of investments in training, development, continuous education. And, like at least in insurance industry, there is minimum 100 hours of requirement, and then there is a requirement for continuous training. I guess similar things should be developed for selling financial products. Today in chartered accountancy, I have to undergo a minimum amount of training every year in terms of CPE hours, and that keeps me, continuing as a good chartered accountant. I think the same should be applicable to all the distributors.
That's it. Okay. I'll move to something else, which is one constant refrain that I heard from banks and wealth managers is the sheer paucity of products. Other than mutual funds, there seem to be very few viable large ticket options or established options. Rishi, do you think that's a problem?
Yes, not really. I mean, I guess obviously mutual fund is relatively speaking a well-developed industry, and besides UTI for the last 20 years, we've had multiple players now doing this thing. But over the last 5-7 years in particular, there has been a lot of innovation and a lot of sort of new product creation. One has to be careful about making sure it's the right stuff. But
in mutual funds, or sorry?
No, outside of mutual funds, okay. Right? And so within every asset class, you're seeing interesting sort of innovation, as much as is sort of permitted within the boundaries of what's allowed. But this whole AIF sort of regulations which have come in, which are regulating how you think about essentially private pools of capital in private equity, real estate, or in hedge fund like products, are very good. So we have the largest sort of category 3 hedge fund like product. Ambit does today in terms of doing a long short sort of investing. And so you're seeing a lot of innovation around that. So of course there's existed the PMS, portfolio management scheme, separately managed accounts for many years now. But you are seeing innovation in, as I said, long short. You're seeing innovation in real estate backed products. You're seeing innovation in high yield debt products. And so that continues to be, and I look at that as an opportunity for us to continue to innovate and do things. But from a sort of overall perspective, clearly the assets are currently and will continue to be for a while in mutual funds and insurance. And these things are sort of at the margin right now. For a while we had these structured products which were popular and then since have gone down. But I don't think there's a paucity of sort of interesting investment product and ideas. It's just a matter of looking for it, and if not available, creating it, which is the way approach we've taken.
Okay. And let's see, regulations have shaped this industry perhaps more than any other force or more than any other stakeholder. What is it? Where do you think we are at today? Do you expect more regulations to come in, and if so, what is going to be the duration of the regulations that you should be prepared for?
Is that for me?
Yeah, that's for all of you.
Okay, so I think, at least in my mind, whatever regulations we've seen, I personally don't think we've seen excessive regulation. I think we're seeing regulation in financial services being probably far more enhanced now than what we had seen in the past. That's the case for financial services as a whole. within that, I think wealth management as a business, I think, is seeing its own share of sort of regulation. I think the challenge is that you've sort of seen regulation from multiple regulators in financial services, which is what creates a bit of a dilemma, if you will. But I think to that extent, whatever regulation has come in, most of it, the way I look at it, has been for the betterment. I think all the players have, complied with whatever has come in order to calibrate their business if they needed to calibrate it. And I think it's been for the good of the customer. At the end of the day, we find that the customer is benefited out of whatever regulation has come in. So to that extent, I wouldn't be very sort of negative on whatever regulations have come in. I think they're a part of the game, really, and you have to deal with it. I mean, I don't think there is a way that you'll find a way of circumventing whatever regulations there. It's in your interest to sort of fall in line with whatever regulation there is and deal with it. I mean, I can't see how you sort of work around regulation.
Rishi.
So in some way, I mean, obviously there are many nuances to what is regulation and what is good and bad about it. I agree with Prateek saying I don't really believe there is excessive regulation. The issue I've had with regulation is there is, it's not necessarily always thought through, and it sometimes ends up being implemented in a sort of rather hasty, knee-jerk fashion, right? Which is without giving time to the players to adjust to the proposed changes. The intent is always good, which is about saying, investors need to be protected and appropriately sort of educated to be able to be serviced. Their interests need to be serviced appropriately. That is obviously the intent, which is good. And so I think that my concern is around that. Matter of fact, what I would love to see is probably a little bit more sort of regulation around the notion of qualification and education and sort of things of the sort, so that sort of today theoretically anybody could go up and kind of hold himself out to be sort of a distributor or advisor, and having some more sort of testing, qualification and regular sort of more rigor, just that lets people discriminate, lets clients discriminate between sort of appropriately qualified people and not, and doing that as a continuous basis, I think is essential, and we should see more in that regard. Is what I believe.
Nilesh,
there is a big divide between what regulators sees distribution and what distributors see regulation. Regulators believe that there are lots of complaints against distributors of mis-selling. They keep on highlighting that in every communication. But so far, I don't think so even one distributor has been punished for mis-selling. The distributor believes that regulators are coming out with regulations which impact their business. Penalty of imposition of service tax is one such fact, where you haven't thought about how the distribution business is structured and how the service tax is actually resulting into cascading effect. The distributors have a complaint to the regulator that you are judging us on the basis of complaint which you receive, but there is a vast majority of people who don't write appreciation letters about us to you. So the kind of complaints which you receive compared to the client of clients we service, that's minuscule. The regulators believe that distributors are being probably overpaid and the cost to the consumer for transaction is very, very high and it needs to be curtailed. And distributor believes that, I'm not going to put my son or daughter into this business because there is no future in it. Distributor wants to be regulated by SEBI. SEBI wants to say that distribution should be regulated by MFI for mutual fund. So clearly there is a big divide between where distributors are today and where regulators are today. And I don't think so. They have a difference of objective. The objective of regulator as well as distributor is to protect their customer, to grow their customers' wealth. But the path to reach out to that object is completely different in the minds of regulator vis-a-vis distributor. And the blame lies probably at both ends. I think it's important for distributors to come on one platform. when I was part of one of the platform and we were interacting with the regulator simply said that, look, you are just one of the many who are coming to reach me. And the proposition given by you is completely different from proposition given by someone else. So it's important for distributors to create one common platform, whether you are a bank, whether you are a national distributor, whether you are IFA. If you can create one common platform to interact with the regulator, that will give a big advantage to you. The second thing is there's need to engage with regulator. But one simple suggestion I had given, why don't you go and make all SEBI employees SIP investor? Just interact with them. Let them appreciate what problems you are facing in servicing a customer, in creating a customer. SEBI regulations today want 5-star treatment for all consumers, for all investors. But then for a ODP client, you can't provide 5-star service. There is a disconnect in the business model. And unless until distributor takes that step to inform regulators about their business construct, their problems, their issues, it's not going to get settled at the top-down level. I mean, a simple thing that there are only 500 people who get more than 5 lakh rupee commission check is not known to regulator. They believe distributors are overpaid, but if they were overpaid, why will only 500 people get more than 5 lakh rupee commission? So there is big difference, big divide between the methods of the regulators and distributors, and it's coming because there is very limited interaction. While the objectives are the same, both of you want customers to prosper, but the path, there is fair amount of inconsistency.
Okay. Soumya, your views on?
My views on this, really, I think going forward, I see the role of the distributor and role of the advisor becoming far more distinct. I think the regulator is going to play a role in trying to segregate both these functions over a period of time. It so happened that we started with the distribution model first. The advisory model has only come in over the last 2 years. So it's just very early stages in that space, but I think the regulator is going to try and figure out really the distinction between the role that advisors play and the role that distributors play, because both play very important roles ultimately in the management of wealth and the creation of wealth for individuals at different points in their financial life cycle. So I think it's that's something we're going to see. I think we're also going to see a lot more certification, which is going to come through a point that Rishi made. That is something that I think will also be good for the industry. Better qualified people to advise, better qualified people to distribute. That's something that we're going to see as well.
But again, majority of world has a left-hand driving.
Yeah.
We are right-hand driving. Now, does it make sense to go to left-hand driving because majority of world is over there? We need to be aware of our problems and our situations. We can't be drafting regulations looking at what UK has done.
Okay. But I just wanted to, you raised the point about this distributors having one body to represent them. But is it possible? Is it possible for an IFA from Tuticorin to have the same, approach to business which, let's say, a Citibank or an ICICI bank has? How do you reconcile? I find there to be a huge difference between how Soumya operates and how ICICI operates, how Ambit operates. And we have just 3 here. And they're all big, they're all hugely resourceful. And when you bring in this large things of IFAs, how do you have one this thing?
Prem, your point is absolutely valid. You can't create unity in such a big diversity.
Very diverse.
But in MFI also there are large mutual funds, mid-sized mutual funds, small mutual funds. Now, does it make sense to divide MFI in 3 parts representing large mutual funds, mid mutual funds and small mutual funds? In insurance companies also there are large mutual funds, LIC, small mutual funds, mid mutual funds, bank sponsored mutual funds, non-bank sponsored mutual funds. but they all have combined. It's not that we don't have our problems with others, but we try to create a common minimum program, and once that common minimum program is created, you go and interact with the regulators.
Okay.
So I'm sure there will be problems, but between IFAs, NDs, banks, could there be 70-80% common minimum ground? My answer is yes. Will there be 20-25% difference of opinion? The answer is yes. Today, the need is to bring that common minimum program, like in a coalition government, engage with distributors, create a structure, create that respect for the distribution community which they deserve, and then, split it up for your individual agendas.
Okay. Okay. Now we'll now open up the session to the audience. So there are people going around with mics. So if anyone has a question.
My question is for Soumya Rajan. I just want to know what is the basis of charging fees. Is it cost plus profit, or is it a percentage of AUM, or is it on the basis of the time spent on the client for the family office?
Yeah, actually different family offices use different models. The model that we typically use is really a flat retainer fee with the client depending on the assets under advisory. What we find is that we don't link it to performance, because if we do, then it biases the risk, specifically if it's investment related. But most of our clients are extremely comfortable with having an annual fee that we agree with them right at the beginning for the scope of services that we would actually offer.
Thank you.
Okay. Okay. So, any other questions? Yes, please.
Hello, good morning everyone. My question to the panel is that does all of you think the expense ratio in mutual fund is far too high in the context of India and distribution landscape? On the equity side.
See, as long as market is accepting that expense ratio, it is right expense ratio. If it was high, we would have seen outflows. If it was too low, we would have seen great inflows. But over a period of time, does our expense ratio have to go down? The answer is absolutely yes. The scale benefit ultimately has to be shared with the investors. So if a Vanguard today operates index fund at 37 basis point or 27 basis point, eventually my index fund also will go towards that side. But it's a step direction. It's not something which can be done today. If today we start charging 37 basis point, then there will be no mutual fund left.
You think, as distributors,
I understand.
do you find
Sorry, I think got a follow-up.
No, I wanted to complete this.
Yeah.
As a manufacturer, he's given his view. But as distributors, do you find any resistance from clients? Do the clients ask you, hey, why is this fund charging, 2.5% or whatever?
So I think if you look at mutual fund as a category, from an investor perspective, you need to keep in mind that a customer is always relative, right? He is relative with respect to the investment opportunities that are presented to him. And when he looks at mutual fund as a category, if at all a customer questions the expense ratio, the immediate category that the customer tends to compare it with is insurance, right? And then when you compare it with insurance, it's not really a concern when you look at the mutual fund costs. Also, I think fortunately or unfortunately, whichever way you want to look at it, investors today still invest basis the returns that they are likely to make on a gross basis rather than on a net basis. I think investors are not as evolved yet to look at returns on a net basis. I think this whole thing about mutual fund expense ratio will become relevant when customers transition to really looking at it on a net basis. So to my mind, while I may have a view personally on the expense ratios of mutual funds. But when you think of it from an investor perspective, I don't really see that being really a large item of consideration.
In your discussions
no,
with your
no,
clients.
no.
Rishi.
I agree exactly with what Prateek said. Personally, I do have a view which says this is ridiculously high. But
You think so?
I do believe so. But having said that, the market seems to bear it. Market, frankly, I don't think really understands it. As he said, they are focused not on necessarily the expense payout at all. It's expectation of gross returns. And it's the lack of sort of obvious alternatives to that, right? In terms of what one does.
Yeah. Sorry.
Hello.
You had a follow-up question.
Yeah. So with in the same context of your views, as long as the returns are made for an investor, which is super abnormal, why would the regulator think of only expense ratio? Because you see a lot of funds which has got lower expense ratio, but still underperforming a fund which is having higher expense ratio. So my point is that the performance is taking care of the expense ratio. Then why should regulator be after reducing cost for investor? Like what Nilesh Bhai said, if the world is left-hand drive, you do not be right-hand drive. You can still be right-hand driven the economy because there is no infrastructure accordingly. So why don't we? Is there a valid point from me, or it is still not a valid point in the context of returns that we are making?
It is absolutely valid point. Today you have private equity funds globally which charge performance fees. Yeah. Now that model in India we are not accepting, but we want to follow the model from global markets where advisors are being paid by the client. So you can't be importing selectively. If you want to import the whole system, then import everything. Now on the PMS side, we have performance sharing allowed. Now maybe over a period of time, we can engage with regulators and say that why don't you allow that kind of option even in mutual fund. Let there be the standard options where there is fixed expense ratio, and let there be something which is performance linked.
Hello.
Yeah.
I have a question. See, I have come across some set of wealthy clients or industrialists of the medium size where they are doing extremely well into their business, keep growing in the same business. And when I spoke to them, I don't find any place for us to manage their wealth and all that. They say we are doing very well into the business and not a single rupee they bring out for a wealth management or any other aspect. So do we find any place for ourselves to, help them, convince them about there's some other alternative of the wealth management or any other function? Yeah. So and second is, there are who are fully aware of the things, but they say we are so wealthy, why we need anything, all that, our children are not even able to handle whatever we are having. So what we are going to do about creating more wealth and all that? That's all.
Should I take it?
Yeah, please.
So the first part of the question, right? This is a very common refrain, saying if I'm investing in a business, I'm supposedly getting 30% return back from a business, why do I bother doing anything else? And the only attempt one can make there is from a diversification standpoint, which is obviously there is this sort of single stock exposure, if you like, in your own business. And some people will clearly appreciate that. But having said that, when you dig through that, what people will resist the attempt to is to say, go and invest in sort of packaged products like a mutual fund or whatever else. But guaranteed, these folks will have lots of investment in real estate. They will have lots of investment in other hard assets. And if one broadens the definition of what one is trying to do in terms of advice, one can certainly have those conversations. So if one starts with the pitch of saying, ye mutual fund acha hai, isme dal do paisa sort of thing, then that's a very different discussion to have. But if it's trying to have a broader conversation, I've found that the conversation generally ends up having something to be able to do with them. On the other hand, on the whole thing about, why do we need more money? Again, it goes back to what the definition of wealth is, right? Because if they're happy with saying, I made enough money, I want to put money in a bank deposit, I'm fine with that, then so be it, right? At the end of the day, that's the sort of risk-return profile they want to be able to, they're comfortable with. And you really can't, at the end of the day, everything is about what goal is that particular individual or family trying to achieve. And if that goal is being achieved by what they think they want to be able to do, you really can't or you shouldn't try and counsel them otherwise.
So are we trying to say by your explanation that wealthy needs more investor education than the
No, not at
less
all.
people?
I think, and Soumya, you should jump in here.
Yeah,
But
I think I'd like to comment a little on this because we see a lot of promoters who have traditionally always put money back into their business, and that's really because, again, the return that they've got on their equity has been higher than if you invested that same money somewhere else. The question then arises is that they start thinking about taking the money out of the business when they're looking at maybe starting a new venture, when they're looking at legacy, when they're looking at what does the next generation do if they want to get into a new line of business. Those conversations typically come out in the family office discussions. So not an easy discussion because promoters have always got very good returns back into the business that they've invested into, but I think that's also going to change. And as the ecosystem evolves in terms of investing into other unlisted companies, having alternate investments outside of real estate and mutual funds, these conversations then become something that you would then pursue.
I'll share with you two experiences. Once I had gone to meet someone in Kolkata, and he actually showed his portfolio, which is delivered far better than the funds I was managing.
Yeah.
And he said, why will Nilesh bhai invest with you? Mera portfolio dekhiye. And the performance was really exemplary. So I said, sir, you are a far better fund manager. In fact, I'm happy to give my money to you, provided you can share the secret aapne kiya kya. So then he said, I invested in a particular company which has delivered this great return. If I take that company out, his performance was far worse than my fund. But one stock made all the difference. And it just happened to be that it was his son-in-law's company. Now, that is not investment, it is your business. So many a times people confuse, the investments which they have done as a venture capitalist by funding his son-in-law, by funding his nephew, by funding his friend's friend. Now, those are venture capitalists. You took high risk, high return, and something worked out and you have delivered great return. Majority of clients' own portfolios would have underperformed most of the mutual funds. The second incident also incidentally happened in Kolkata. Went to meet someone. So he said, how much return you can guarantee? So I said, we don't guarantee return in mutual funds. So I said, if I shout out of this window, there will be people who will be willing to borrow at 36% interest rate. So if you're not going to give me 36% return, don't even come to my doorstep. So I said, sahi baat hai. Then I said, sir, you must have earned 36% return on your portfolio. So he said, yes. And I said, आपका पैसा तो एकदम खानदानी लगता है, रईस लगते हो आप. So you must be earning for many years. He said, yes. And I said, you would have started also quite early. He said, हाँ मतलब हम तो मारवाड़ीज हैं, जहाँ से जब से मतलब होश आया पैसा बनाना चालू कर दिया. So I said, sir, in my mathematical calculation, if you had started with $1 million and you were earning 36%, in 58 years you would have made $50 trillion. That means you would have owned the whole world, from Apple to Zensar Technologies. But as far as my knowledge goes, you don't even own the building in which we are sitting on. So whom are you trying to fool? Is 36% return your birthright and are you generating? And then, he opened up. He indeed was making 36% return, but then losing 50-60% in a bear time. Then again making 36%, then again losing. So many a times people are prejudiced by their own perceptions. And we need to bring the fact in front of them. As long as you can bring the fact, I think on an average a distributor, a good advisor will be able to add value even to the best of the industrialists. If you see in the 70s who were the top 10 richest Indian, they are probably not there in 2010. The same is 80 to 2010, 90 to 2010. So wealth keeps on churning.
So great. We've now run out of time, and so Anita. So may I invite Kailash to come and give a token of appreciation to the panelists. group photo.